JPMorgan Chase, Wells Fargo, and Citigroup, three of the four largest banks in the US by assets, reported earnings yesterday and their outlook showing a resilient US economy. BlackRock also hits a record $12.5 trillion in assets despite what you could describe as turmoil. A decent quarter based on still early Q2 releases amid the uncertainty surrounding trade relations, plus a mixed US June inflation read seems to be leaving investors still in a fog in need of clearer direction. The Nasdaq led other indices as big tech saw some traction with Nvidia and AMD getting the green light to resume sales of some advanced chips, including Nvidia's H20 AI chip sales to China. Hello, this is Bode Oshosami, and welcome again to Global Business Insights, where we bring perspectives on the business headlines that attempt at more depth on the headlines, depth to help you navigate the more complex context. Nigeria's headline inflation rate fell for the third straight month in June to 22.22% year-on-year from 22.97%. Month-on-month CPI was 1.68%, higher than 1.53% recorded in May. The Central Bank MPC meets next week. In the next episode, we have Economist Opeyemi Agbaje looking at the data and implications for the MPC in more detail. Today we look at the latest inflation data as well as what we are learning so far from second quarter earnings releases of the major US banks. But first, more business stories. UK inflation came in hotter than expected at 3.6% in the year to June. The Bank of England previously said inflation would peak at 3.7% between July and September before dropping back to its 2% target. Traders are trimming their bets now on a rate cut at the next Monetary Policy Committee meeting, given the hotter than expected inflation print. Chancellor Reeves urged the financial industry to change the negative narrative around savers and investing money in stocks to help grow the economy. Still in the UK, the FTSE 100 for a brief period went past 9,000 points for the first time as US stocks benefit from global investors diversifying away from the United States. The UK blue chip index so far this year has outperformed the S&P 500 and the Stocks Europe 600 indices, having gone up 10.3%. Also, the advantage of having struck an early trade deal with the US may also be helping investment inflows. China's economy was up by 5.2% from April to June in a slowdown from the 5.4% expansion in the first 3 months of the year, still faster than expected in Q2, and this despite the uncertainty triggered by US tariff hikes. Growth in exports were also up due to front-loading to avert impact of expected US tariffs. JPMorgan Chase and Citigroup both surpassed top and bottom line estimates, while Wells Fargo largely missed. Citigroup had its best second quarter for traders in all of 5 years in what looks like a robust performance for the banks as they start to announce their earnings, despite all the turmoil still playing out. President Trump yesterday said the US struck a deal with Indonesia with 19% tariff on Indonesian goods under a new agreement. This is as the US presses for better terms with trading partners and ways to shrink what it sees as a huge, unacceptable US trade deficit. Bahrain's state news agency reported today that Bahraini and US companies signed agreements worth approximately $17 billion aimed at strengthening economic ties and advancing cooperation across key sectors. Also, Cisco Systems will be providing digital solutions for Bahrain's government information and telecommunications infrastructure. Thinking Machines Lab, an AI startup founded by Mira Murati, raised $2 billion in new capital, valuing the firm at $12 billion. Ms. Murati has recruited a team of researchers from OpenAI, where she was previously Chief Technology Officer, also convincing NVIDIA and AMD, that's the two giant chip makers, to invest. Our first deep dive looks at the latest US second quarter bank earnings. JPMorgan surprised positively with a gain on investment banking. That was in Q2. Markets had expected a dip. Second quarter earnings fell 17% to $14.9 billion or $5.24 a share from the year earlier period, when it had a $7.9 billion gain on Visa shares. JP Morgan still topped estimates for the quarter as it backed out a $774 million income tax benefit that boosted per share earnings by 28 cents. Revenue also fell 10% to $45.68 billion. Higher expenses weighed on net interest income. Still, investment banking fees, higher than estimated by 23.3%, was the clearest signal on JP Morgan's performance, which did not play like a bank in an economy facing an impending recession. JP Morgan CEO Jamie Dimon also warned that independence of the Fed remains key. US Treasury Secretary Scott Bessent earlier had said there are no plans to fire Powell, but it would be confusing if he stays on the FOMC after next year, May, when his tenure expires. Wells Fargo did beat second quarter total profit estimates but reduced its 2025 guidance, also after missing estimates on net interest income, sending the shares of the lender down. The bank said in April that net interest income growth would be at the low end of the 1% to 3% range. Now the bank says its interest income would see no growth from the 2024 level of $47.7 billion. Citigroup announced a surprise beat on net interest income at $15.1 billion, better than the $14.05 billion expected. Citi also beat expectations on banking revenues at $1.92 billion in the second quarter. Citigroup continues to milk the higher market volatility linked to tariffs and geopolitical tensions. Revenues from the markets division were up 16% year-on-year to $5.9 billion, while the group's wealth division, which serves high-income clients, posted a 20% rise in revenues as investment banking fees also rose 13%. In summary, amid the tempestuous environment, banks see more customers seeking advice and guidance on where to park their funds in a market still awash with liquidity and an economy showing remarkable resilience. Also, consumers are generally staying on top of paying off their debts, and we are seeing demand for credit rising again as corporations are less anxious than they were in the first quarter of the year. Next, a closer look at the mixed US June inflation print that came out yesterday. Although the headline annual inflation US June print came in at 2.7%, which was higher than 2.6% expected, the month-on-month underlying or core inflation print was under the 0.3% expected when it came in at 0.2%, also marking 5 consecutive months of reads coming below expected month-on-month core CPI. Year-on-year core inflation came in at 2.9% as expected. The index for shelter was up 0.2% and was the primary factor in the all items monthly increase. The details also show that tariff-sensitive items like apparel, footwear, toys, household furnishings, and home appliances saw inflation inching up, while services may have seen less demand pull, offsetting the rise in goods prices. Prices for used cars and trucks also declined 0.7% on a monthly basis, and new vehicles decreased 0.3%, contributing to less than expected month-on-month core CPI. On food prices, the index for meats, poultry, fish, and eggs fell 0.1% in June, as a 7.4% decrease in the index for eggs was partially offset by a 2% increase in the index for beef. The dairy and related products index also decreased 0.3% over the month. Markets saw the data as evidence that Powell was right to expect a transitory uptick in some items due to tariffs, and a September rate cut looks out of the question as FOMC awaits more data from the personal consumption expenditure index print and better clarity on how transitory tariff-driven inflation could really be. We close by looking at how Africa and, say, countries like Nigeria should be responding in a very different emerging world order. The world has been shifting from a US-led, somewhat liberal order to a different, more multipolar order, with the US slowly backing out of global leadership, leaving a vacuum that is increasingly being filled by emerging markets, regional blocs like BRICS, with a parallel China-led system. We could also be seeing emergence of new spheres of influence with might makes right as the guiding principle. How should Nigeria be responding in this type of world? First, there's a lot of noise to be tuned out, and one needs to be focused on the new signals and opportunities as influence maps change significantly. Like someone said, in times of uncertainty, be reminded that a lot remains unchanged, and the focus should be on what is within your control. The imperative for Nigeria remains to strengthen business competitiveness by aggressively shaving costs of doing business, improving infrastructure, and de-risking the environment to attract many investors who are now desperate to diversify investments and their supply chains. There's also a need to tighten security, confront corruption more boldly to give investors more confidence, while expanding domestic production capacity, incentivizing also new value-added manufacturing and investments in the new technology sectors. Beyond pursuing multilateral continental bloc deals like leveraging a fast-tracked AfCFTA, Nigeria should also pursue bilateral trade deals where there are win-wins. Growth spots like India and emerging Asia could be offering bilateral opportunities as China, Russia, and maybe Brazil come under more geopolitical flak. A more decentralized world order will present new challenges as the post-World War II system slowly collapses. Challenges include high costs of trade, lack of mechanisms to peacefully resolve conflicts, also possibly fostering conditions for imperialistic expansion. Watch China, Taiwan. All this will require more geopolitical alertness. Also, as new institutions emerge to fill the vacuum, interests of Africa and developing economies must be pushed better than what we saw in the post-World War II order. We also got US PPI, that is wholesale inflation month-on-month, for final demand unchanged in June, while the annual PPI print softened to 2.3%, lower than 2.5% expected, perhaps calming some earlier panic that tariffs are pushing inflation out of control. Goldman Sachs reported second quarter earnings before the opening bell, topping both top and bottom line estimates. Morgan Stanley also smashed Wall Street expectations on the back of higher trading revenues. Bank of America Q2 results were mixed, beating estimates on earnings but missing on revenue. All this as big American banks benefit from strong trading results and expansion of consumer credit. OPEC says Nigeria's average daily crude oil production rose to 1.505 million barrels per day in June, beyond its quota. Asia-Pacific markets were closed mostly lower after the US said it had reached a preliminary trade agreement with Indonesia. European stocks were also mixed after US data suggested tariffs were causing inflation, causing a scaling back on rate cut bets amid tariff-related uncertainty. US markets, however, opened up after tame PPI and strong bank results. Well, that's it on this episode of Global Business Insights. This is Bode Oshosami. Thank you so very much for watching. Bye-bye.